Before we get started, quick reminder. If you want clear, honest breakdowns that focus on risk first, not hype, make sure you like this video and subscribe. It helps the channel grow, and more importantly, it tells YouTube that thoughtful investing content still matters. Now listen carefully. This video is not about chasing the next hot ticker. It's not about headlines. And it's definitely not about buying what already ran. This is about positioning before the crowd realizes what's happening. Today, we're breaking down 5 stocks that I believe are set up to significantly outperform in 2026. Not because of stories, but because of valuation gaps, operating leverage, and a macro shift that's already underway. These are companies that are cheap relative to their growth, generate real revenue from real customers, benefit directly from falling interest rates, and sit at a point where profits can scale much faster than investors expect. I'll walk you through the logic behind each one. You decide what's worth your capital. And, as always, do your own due diligence. To understand why these stocks matter, we need to start with what's actually happening in the market right now. Markets feel uncomfortable. Tech peaked, pulled back, tried to bounce, and failed again. That's made people nervous. One camp says this is just another dip. Another says the AI bubble is about to collapse. But when you look at the data, panic doesn't hold up. This isn't a crash, it's a rotation. Money is moving away from crowded mega-cap tech and flowing into areas that have been ignored for years. Small and mid-cap companies behave very differently from mega-cap tech. They carry more leverage, they're more sensitive to borrowing costs, and when rates fall, margins expand faster. For years, high interest rates punished these companies. Debt was expensive. Capital was scarce. Growth was delayed. Now that pressure is easing. As rates fall, debt servicing costs decline. Refinancing becomes easier. Capital flows return. And profitability accelerates. This is why market leadership changes after rate cut cycles. But here's the mistake most investors make. They wait for confirmation. They wait until earnings explode. They wait until headlines turn bullish. By then, the move is already halfway done. Which brings us to the core concept behind this entire video. Operating leverage. Operating leverage is what separates stocks that drift sideways from stocks that explode. A company spends years building infrastructure, platforms, software, or systems. Early on, profits look weak, costs are high, margins look unimpressive. But once revenue crosses a certain threshold, something changes. Costs stop growing. Revenue keeps rising. And each additional dollar becomes disproportionately profitable. That's when Wall Street suddenly discovers the stock. Most investors buy after that moment. This video is about companies just before that moment. Now, let's get into the list. Let's start with a stock the market has punished aggressively, not because the business failed, but because sentiment collapsed. Before I say the name, understand this. AI does not function without servers. Chips alone do nothing. This company builds the full system. That stock is Supermicrocomputer, SMCI. SMCI designs and builds AI server systems, mounting, cooling, power delivery, and customization. If NVIDIA sells the engine, SMCI builds the race car. The stock has been crushed, down massively from its highs, hit by accounting headlines, hit by fear, hit by uncertainty. The chart looks ugly. Sentiment is toxic. Most investors won't even look at it. That's exactly why this setup matters. SMCI is currently trading near a 0.5 forward price to sales ratio. That valuation usually implies a dying business. But revenue is still growing. AI demand is accelerating. And every AI chip still needs a physical home. This stock doesn't move smoothly. It moves in violent waves. When sentiment shifts, it doesn't drift. It explodes. Right now, the market is pricing SMCI for disaster. Its execution merely stabilizes. Valuation expansion alone creates upside. This is classic deep value. AI infrastructure mispricing. Adobe is a perfect example of how price action can lie. For nearly 2 years, this stock has gone nowhere while the rest of tech surged. Dead money. Boring. Ignored. That underperformance is the opportunity. Currently, this is trading around 354.24 USD, as you can see in the chart. Long-term chart showing sideways movement. Adobe hasn't crashed. It's done something worse in the market's eyes. It's gone nowhere. Highlight long consolidation range. This is 2 years of compression. No excitement, no momentum. Just steady erosion of interest. Overlay valuation or earnings context. And yet, this price now reflects near decade-low valuation levels for a company still growing earnings. Focus on stability versus volatility. This isn't a breakout chart. It's a coiled one. Adobe now trades near a 10-year low valuation on a forward earnings basis, despite massive free cash flow and expanding margins. Investors feared AI would disrupt Adobe. The stock priced in that fear long before fundamentals deteriorated. Now pricing tells a different story. At roughly 14-15x forward earnings with double-digit EPS growth, Adobe is priced like a stagnant legacy company. But this is still the dominant creative platform integrating AI across its ecosystem. This is not a hype stock. It doesn't spike. It compresses quietly, then compounds. Patience is rewarded here. Hims and Hers, as known as Hims, is not a calm stock. It swings, it sells off, it frustrates. Despite strong revenue growth and improving profitability, the stock has spent long periods consolidating or pulling back. Why? Because the market still treats this as a speculative consumer play, not a subscription healthcare platform. Hims. Currently trading at $35.47. At current levels, Hims trades at a valuation that doesn't reflect its margins, its recurring revenue, or its subscriber economics. When you see on the chart, this is not a smooth chart, and that's important. Hims moves in sharp waves. What matters isn't the swings, it's that each pullback holds higher ground. This is what mispriced growth looks like before it becomes obvious. When sentiment turns risk off, it gets punished. When sentiment returns, it reprices violently. Hims is priced for doubt, not execution. So now the next stock is Salesforce. Salesforce is a textbook rotation setup. Down roughly 30% from highs, even as the market pushed higher. Why? Years of overspending, weak margins, empire building. The stock priced in frustration. But the business changed. Margins are expanding. Costs are under control. Buybacks are aggressive. Free cash flow is massive. Yet CRM trades at 5-6x forward sales, well below historical norms. Salesforce is currently trading around $259. So this can be the game changer in 2026 if you can consider buying this stock, as it has potential, so you can think about this. But do your due intelligence before investing. Now let's talk about the final stock on this list. Before I say the name, here's what matters. This is a company the market completely gave up on. The chart doesn't show disappointment, it shows capitulation. During the rate hike cycle, this stock was treated like something fundamentally broke. It wasn't gently sold, it was abandoned. At one point, investors stopped asking questions and just wanted out. And today, after all of that, this stock is trading around $15. That price alone makes people dismiss it. But price doesn't tell you what happened underneath. Because while the stock collapsed, the business didn't. Customers stayed. Cash stayed strong. And demand for automation didn't disappear. It simply paused while money got expensive. This is UiPath. UiPath operates in robotic process automation, software that helps companies automate repetitive work. Invoices, compliance, back-office workflows, the kind of tasks businesses want to automate when budgets loosen again. Right now, UiPath trades with a PEG ratio below 1, roughly $1.4 billion in net cash, and improving free cash flow. That combination matters. This isn't pricing based on execution failure. It's pricing driven by macro fear. And historically, stocks like this don't recover slowly. They don't grind up inch by inch. They reprice when conditions change. Falling rates don't fix every company, but they do change the math for businesses built around efficiency. UiPath doesn't need hype. It just needs the environment to stop working against it. Here's how to think about all of this. Falling interest rates change the landscape. They don't guarantee winners, but they do expose mispricing. None of the stocks discussed are certainties. That's not how markets work. What they are, though, are setups. Situations where valuation, operating leverage, and macro conditions are starting to align before consensus catches on. The goal isn't excitement, it's positioning. If you understand operating leverage, if you understand market cycles, and if you manage risk instead of ignoring it, 2026 could look very different than today. Start with risk. Let returns be the outcome, not the assumption. And if this breakdown helped you think more clearly about that, like the video, subscribe, and stay disciplined. That's how you stay in the game long enough for opportunities to matter.